So we're a little bit past Thanksgiving already. We're going into the Christmas season really soon here in the US. So I decided to make a kind of holiday themed example of the fair value through net income method. So this is when you purchase an investment in an investee and the ownership percentage is less than 20%. So you don't have significant influence. In this example, I have it at 10% ownership. So suppose we have two companies. The investor is called Turkey Company and the investee is called Duckin Company. So, turducken. I've never actually eaten a turducken. I think it'd be pretty tasty. Apparently, I hear there's a version that's called a pig turducken, where you stuff a turducken into a pig, which sounds completely atrocious and delicious at the same time. Um, Anyways, it makes me wonder what happens if you elevate that one step further. I'm pretty sure someone's tried to stuff a pig turducken into like a deer or a horse or something at that point. Um, I guess a cow would be the most um, instinctive option in the United States. So, anyways, suppose that Turkey Company acquires an investment in Duckin Company, and that investment represents only 10% ownership of all of Duckin's available stocks. And the price that was paid by Turkey was 100,000. Sorry, it was total of $1 million paid for 100,000 shares at $10 per share. So that's the total amount paid of $1 million. Uh, while we were making that transaction, Turkey had to pay $5,000 in brokerage fees. And then we learned during the year that Duck and Company earned $3 million in net income on March 1st of year one. This is all for year one. We found out that Duckin paid dividends of $200,000 and oh, sorry, the dividends were declared on March 1st, year one, but they were paid on May 1st, year one. So that's a clear distinction. March 1st, the dividends were declared for $200,000, and in May 1st, they were actually paid. So keep that in mind. That's two separate journal entries. Don't get these mixed up. And at the end of the year, the fair value of Turkey's investment in Duckin. Oh, I meant to change it to something else. Actually, this works. Let's make that a little clearer. It has increased to $1,100,000. Yay. And in the next year, on January 30th, year two, Turkey sells that investment for $2 million. And then later on, we'll go over the balance sheet, income statement, cash flows, and the effects of this transaction on there. So I'm going to have to do a bit of scrolling up and down to get to all parts of this question. All right, so first off, we're going to record that investment. So let's change the color of our pen. So when did this happen? Oh, I guess I didn't write down a date. I suppose it doesn't matter. So whatever date we buy the investment. Now, under the fair value through net income method, you're going to see the investment equity securities account being used a lot. That's something that I mentioned in a prior video. So first off, we're going to buy the investment. So very simple. Under the fair value through net income method, when you have less than 20% ownership, you're going to increase the investment in equity securities account, which is an asset on the balance sheet. Something that they don't use often in accounting courses is just arrows to indicate the direction that the account is moving. I don't understand why. Um, I find that if you have a good foundation in accounting, it helps. But at the same time, even when you don't, it's a really good way to scan information. So I'm just going to label increases and decreases to accounts this way. So we increase the investment in equity securities account, which is an asset on the balance sheet. What do we credit? Very simple, cash. We paid cash for this. So cash goes down. And how much do we pay for it? So it was $1 million straight up for these 100,000 shares at $10 per share. We paid $100,000, but don't forget that we have brokerage fees. And these actually get included in here. So we have 100K shares, and suppose they didn't tell you the exact calculation, so we have $1 million here. for the investment itself. We also have to add in these fees, which was not $200,000. How much was it? $5,000. So not that much. 1 million, 1 million, and I'm really struggling to write the commas for some reason today. 1 million and $5,000 paid for these brokerage fees and for the actual investment itself of $1 million. Got it? Debit investment, equity securities, credit cash. And then after that, what happens? So here we see that the investee earned net income of $3 million. So under the fair value through net income method, what do we report for net income of the investee? Trick question here. We actually do not report this. So there is no journal entry. There is no JE for your percent of the investee's earnings, aka their net income. All right. Under the fair value through net income method, the investee's earnings do not get a journal entry of their own. You do not record it. And now we move on to the next transaction, which is here. So Deccan declares dividends. Let me put something in there. So these are dividends declared. This is not the pay date. Dividends declared. On March 1st, year one, it was $200,000 of dividends declared. I find that the journal entries for the fair value through net income method to be very straightforward. So if you declare dividends, what is it? Debit, dividends, receivable. We haven't received them yet. That's not until May. So in March of year one, we have dividends receivable. It increases. So here I put a straight dollar amount. Usually how they list this out on the exam is actually they'll give you a percentage. So just suppose that they have to put something else instead. If it's $200,000, I would put a 20% dividend, just to write that all out. Suppose it had been a dividend of 20%. Oh, actually, I think my math doesn't quite work out this way. Because of the ownership percentage was 10%. That would put us into the equity method. So let's scratch that actually. See, as I'm creating these examples, I mess up here and there. That would actually not make sense. 10% ownership, 10% of the dividends. Wait a minute. Am I thinking about this the right way? Actually, no. Sorry. We can't work backwards quite in this way. So what I'm going to do, suppose it's 200,000 of dividends declared by Deccan. We take 10% of this amount. Sorry, this is what happens when you don't think about the examples all the way through. So we know that it was $200,000 of dividends declared. This is not just the dividends going to Turkey Company. This is for all shareholders. There we go. We are on the right track now. Maybe I should write in cursive. It's a bit neater. And we have 10% ownership. All right. Fair value through net income method, okay? Cannot be more than 20% ownership, given that you still don't have significant influence. Something to know, like if you have 10% ownership and you have a huge sway on the board of directors or you're on the board itself, then you may not be able to apply the fair value through net income method, even though you only own 10%. So keep that in mind. This is just a general rule in terms of percentage ownership, but you could have significant influence with a smaller amount of ownership or with a lot more ownership for that matter. It just really depends on the circumstances. So read the question carefully. In this situation, we'll just assume it's fair value through net income because it's not otherwise stated. So 10% of those dividends to all shareholders of $200,000, we get only $20,000 of that. Bummer. Okay, dividends receivable. What goes against receivable? This is an asset account on the balance sheet. So we've got to have an account from the income statement. Dividend revenue. That's right. Our dividend income is actually the term that's used more often. That increases. Also, let me underline that so I can sort out by $20,000. And then now we actually get the dividends later on. Hooray. It's May 1st and it's dividend day. So we're going to have to reduce this account right here. First off, show me the money. We've got the cash for $20,000. This is an asset account on the balance sheet. And then dividends receivable goes down. It's also an asset on the balance sheet for that same amount. All right. And then let's talk about unrealized gains or losses. Unrealized gains or losses. Because as of the balance sheet date, we found out something interesting. At the end of the year, on December 31st of year one, at the end of the year, we found that the fair value of our investment in Duck & Company has actually increased to $1,100,000. That's a one right there. $1,100,000. All right. So what is the journal entry under the fair value through net income method, which is also called the mark-to-market method? That's the big hint right there. On 12/31, year one, end of the year, this is fair value through net income, fair value through net income, or it's also called mark-to-market. We have to mark this up to market value. So I'll give you a hint. We'll have some potential unrealized gains or unrealized losses. And under the fair value through net income method, that investment account and that investment equity securities account gets used very, very heavily. So we have investment in equity securities. That's assuming if we have a gain. Let's calculate how much it is right now. So the investment in equity securities account, we had this total right here, $1,005,000. That was including the brokerage fees. Let's write it somewhere further to the right side. This was our carrying value, including the brokerage fees and the price we paid for it at the start of the year. At the end of the year, how much is it worth? $1,100,000. So that's a good thing. Seems like we had a gain. It increased to $1,100,000. $95,000 as an unrealized gain. It's unrealized because we have not sold it yet. So this is an increase in our investment account of $95,000 and then a credit for that unrealized gain. Where does that go? If the investment is a balance sheet account, this goes on the income statement account for that difference. $1,100,000 new fair value as of December 31st on the first year, minus our old carrying value. All right? So $95,000 gain. And now we're going to look at the disposal. On January 30th of year two, we sold our investment for $2 million. Let's choose a different color. Let's see. So January 30th. I like how the yellow looks. It's very bright. We sold it. So with journal entries, start off what you know. For sure, you got cash. We sold over $2 million. That's great, $2 million for the amount in which it is worth. So how much is left in that investment account now between all these journal entries? Initially recorded $1,005,000. And there's a gain or a loss that has to be recorded. All right, give me a second to get my computer running up again. Sorry, having some technical difficulties. All right. So now that we are selling this investment, the journal entry that we are going to make, we increase it by the cash amount that we received. Okay. All right. And then we account for the gain or loss on disposal. Now it's not going to be, all right, I got that working again. Now it's not going to be an unrealized gain or loss at this point anymore. We're going to credit, I'll start off with here. Investments and equity, securities. And how much is it worth now? Started off with $1,005,000. Increase it by $95,000. So it has a $2 million value. Oh, so I guess we don't have any gain or loss in this situation. It's just flat up sold it. That's a bit unfortunate. I was kind of checking my math here to see if it was going to work out, but it seems like I didn't plan this example as thoroughly as I thought it would be. And there's no gain or loss in this situation. Um, if you had a gain or a loss, though, is how it would look. Suppose you had a gain, and that would mean that you got more cash than the investment equity securities, then you would have credited a gain to make this journal entry balance out. If you had a loss, it'd be up here. But yeah. All right. And now let's talk about how this all affects these separate accounts. Instead of just going through like all the numbers, what we could do is just go over like where things get categorized. We kind of went over this in the last video too. So a balance sheet, under the balance sheet, that investment in equity securities account goes under the balance sheet. Under the income statement, this is under non-operating, to have any gains, losses, revenues, expenses. And under the statement of cash flows, remember, so dividends, received dividend income. I like to think of it in the same category as like getting interest income, part of your operations, general operations. But what's different is when it comes to when you buy or sell the investment itself, not dividends, but when you buy and sell the investment itself, that goes under cash flow from investing activities. So CFO is CFI. All right. So I hope you like that example that I gave of Turkey acquiring an investment in Deccan. Hopefully this helped you imagine and visualize all of these journal entries and where it all goes on the different financial statements. So let's do a quick overview actually. So Turkey company in year one decides to acquire an investment in Deccan company. They bought 10% ownership, 100,000 shares for $10 per share. That's a total of $1 million. They paid $5,000 in brokerage fees to carry out this purchase. During the year, we find out that Deccan Company earned net income of $3 million. And on March 1st, year one, Deccan declared $200,000 of dividends. This is going to all the shareholders. We're only going to get 10% of that, remember, because we only need 10%. Now, in May 1st, they paid out those dividends. At the end of the year, the fair value of investment is increased to $1,100,000. Yay. So we'd have some unrealized gains there. And in January 30th, year two, we sold the investment for $2 million, which was an unfortunate choice. As we could see, there were no gains or losses in this example, but hopefully you get the gist of it. So let's go over everything again. On the date of the investment, when we purchase that investment, we debit the investment equity securities, which is an asset on the balance sheet. This is the amount that we paid, 100,000 shares at $10 per share. So we paid $1 million for this investment, but you also have to remember to add in fees. So brokerage fees are included. So debit the investment equity securities for $1,005,000, credit cash for the same amount. When the investee has earnings under the fair value through net income method, we do not create a journal entry. We do not record that. Remember that. On March 1st of year one, dividends are declared. Yay! So we debit dividends receivable, which is an asset on the balance sheet. The dividends declared for all shareholders was $200,000. We only get 10% of that. That's our ownership amount. Boohoo. We only get $20,000 of that. And then we increase our dividend income by the same amount, $20,000. On May 1st, year one, those dividends are actually paid out. Yes, we get paid. So Turkey records a debit to cash, an increase in an asset account on the balance sheet for $20,000, and a credit to dividends receivable, also reducing an asset for $20,000. And then at the end of the year, what do? Under the fair value method, also known as the mark-to-market method, we have to increase the investment in equity securities by the amount of this unrealized gain. How do we realize that it was how do we calculate that it was a gain? Well, so the carrying value of the investment, including the brokerage fees, was $1,005,000. The fair value increased to $1,100,000, which was a $95,000 unrealized gain. Under the fair value through net income or mark-to-market method, we have to record unrealized gains and losses. So we debit the investment in equity securities, that's increasing an asset on the balance sheet for $95,000. We credit unrealized gains, which is an income statement account for that delta of $95,000. All right. Oh, technical difficulties. And then when we actually sell this investment on January 30th, year two, we sold the investment, we debit cash. We sold it for $2 million in this situation, and then we credit for the amount that the investment was worth, which is $2 million after we marked it up to the fair market value. There was no loss or gain in this situation. All right, so hopefully this helps you understand an example of the fair value through net income method.